looking past the fact that a lot of these job losses are temporary. The second largest share of job losses have been in the healthcare industry. It's really been in ambulatory health. There's been doctor's offices and dentist offices. They are going to reopen. They're probably not going to replace all of the jobs they lost, but they'll probably replace 3/4 of the jobs that they lost, and the recovery there should be fairly quick. The healthcare industry was not overly efficient, and so I think that we're going to see some efficiency gains that are going to come out of here, and I think we're also going to see some touchless technologies in the doctor's offices and more telemedicine as well. The next biggest losses have been in retailing. Those layoffs have not shown up as much, and then amusement and entertainment. Those layoffs have not shown up as much. They may bleed into May or June. In terms of retailing, I've always been, I don't want to say bearish on physical retail, but if you've seen me, I spoke in Charlotte, I guess about a year ago, and I said I don't think there are any shopping malls that will exist in their current form. That I don't think that there's any reason for a shopping mall in its current form. Even successful malls like South Park, I think, are going to have to be broken up and remade. And South Park is probably further along than most. It's got great demographics. You know, if Macy's is going to close 3/4 of their stores, they'd probably hold on to the South Park store. But as more and more major anchors go bankrupt and don't come back and cease operations, you're going to be able to see a lot of people leave, really get out of those leases. I don't think retailing was losing jobs in a pretty significant way before the recession. And you had a lot of people that were only profitable because they have so much depreciation, and they have, they've got cash flow positive. They're not, they really have no way of getting capital in their business. Short order on retail, because that recessions tend to accelerate trends that were in place, which was the shift to online retailing. If you exclude grocery store sales and auto sales from retail sales, and look at what the online share was, online has accounted for 54% of the growth in retail sales over the last decade. So if 54% of the growth is going online, there is no way in hell that the rest of those guys are going to be able to raise capital. So this recession is going to wash out a lot of the weaker hands out of retailing, and probably speed up the remaking of that. In terms of what kind of recovery we're going to have, there's been a lot of questions. People they like to look at letters and things, and it's sort of like a Rorschach test in that you could make it look anything you want it to. We're going to see GDP decline like 25%. So the front end of that V or W or whatever you think it's going to be is pretty defined. And we're going to see a rebound in the third quarter, probably 9-10%. So that'll look like a V-shaped recovery, but you have to recover. You have to grow a whole lot more. You have to grow a lot more than that to recover the loss that we're going to have in the second quarter. So I think it's going to look sort of like a square root sign, but not flat after that. It's just going to be down, have a little bit of a V, and then it'll start curving up. And we think it'll probably take all of next year, probably till early 2022, to get to cover the jobs that we've lost. In terms of North Carolina, and I'm going to just go through the quick summary page, and then we'll go through some of the charts. We feel like we're going to lose 420,000 jobs this year. Jobless claims have actually been more than that, but we think we're going to lose more than that in the near term, gain some of that back by the end of the year, end the year with a net loss of about 420,000 jobs. There's also, some of the people that have filed for unemployment claims don't qualify for unemployment because they're independent contractors. The law is going to change on Friday, and so they'll be able to get federal benefits. So jobless claims don't necessarily translate into job losses measured in non-farm employment. If you're an independent contractor, if you drive for Uber, the best sense that I can get is that Uber's business is down about the same as restaurants and entertainment, about 85-90%. You'll be able to file for a claim and get $600, up to $600 in federal unemployment insurance. In terms of where we are with the virus, these are global numbers, and I don't know that that's the best indication there, but but we have seen the curve flatten in most places. North Carolina is actually the best positioned state in the South, in that we have, if you're looking at the guidelines where we should have fewer than one death from COVID per million persons of population, or probably 10 or fewer a day in North Carolina. We should be there by the first or second week in May. Georgia, which is opening up, is probably not going to be there till June, but they're not opening up in the way that a lot of people think, but they're opening up pretty aggressively. We can talk about that in Q&A if you want. Go ahead and flip to the next one. I'm not going to go through in great detail most of these slides because I want to make sure we have time for questions. In terms of jobless claims, 22 million jobless claims, as I mentioned, they peaked in the second week. I don't think we're going to re-hit that high, although we have expanded criteria next week. So, be some big numbers like Disney, their layoffs took effect this week. So we're going to see some big numbers that are going to come in there. But at the same time, Boeing's going back to work, BMW is going back to work. So we're going to see some of the continuing claims come down a little bit. Go ahead and flip to the next one. In terms of overall employment, 700,000 job loss in the month of March. I would say, estimate for April is going to be a 21 million decline. So 30 times that, and it'll render our graphs useless because everything else will look puny compared to that. But we're going to capture all of that job loss in 1 month. Go ahead and flip to the next one. This gives you some. I think we have some detail on the. This shows you the history of leisure and hospitality. Typically, in a recession, leisure and hospitality holds up reasonably well. Most of these jobs are at restaurants. Just as in brick and mortar retailing, there are shifts going on in leisure and hospitality. There's been a shift away from full service dining toward fast casual. And to some extent, even drive-through toward fast casual. And so not drive-through, fast food. Yeah, fast food towards fast casual. And so we're seeing, and the advantage of fast casual is that you have higher throughput and less labor. And a good example of fast casual, like the leader in that is Chipotle. We've had all these innovations in Middle Eastern restaurants. You have a lot of people that are putting that same basic footprint in, which was really kind of an upscaling of the Subway model to really think about it, but which was another model that was very efficient, from a labor standpoint. So the point I'm getting at here is that we're probably not going to recover all of the jobs that we lose in leisure and hospitality, as horrific as those losses are. And the comeback there is going to be slow. Restaurants are going to have to open up in a way that they allow for social distancing. So maybe the state's going to say you can only have 20% of the fire capacity in-house at one time, or maybe it's 30%. And they'll probably tier it up. They're also going to need to come up with a consistent set of protocols on how waitstaff are going to interact with customers, so that people feel safe enough to go out to restaurants. So it's going to be a slow road back. Go ahead and flip to the next one. Here's retail trade. As I said, you can see that it's been pretty negative even before the recession. So we have the 1 month of declines here, but quite frankly, that 46,000 drop that we had in March, it's nothing. I mean, it's going to be much bigger, much bigger than that. And I don't think we're going to recover the job losses for the foreseeable future. We will see a bounce back, but we're not going to recover. Go ahead and flip to the next one. Healthcare has been the surprise here, and that healthcare rarely sees employment declines, and we saw a very large employment decline in healthcare. If you tried to go to the doctor's office recently, I actually had to go to a doctor's office. I was surprised that I was even going to be able to. I was the only patient that was in that doctor's office at that time, and receptionist was on the phone with the unemployment insurance folks. The doctor came out to see me, and it was very lots of social distancing. Telemedicine is going to be here in a big way and stay in a big way. The recovery here, most of the forecasts that I've seen by major national, Moody's, the IHS, do not even incorporate any job losses in healthcare. And I think this is going to be a slow road back, because healthcare, if you looked at the numbers, hours worked in healthcare versus output, which is hard to gauge in healthcare, but it was negative. There was negative productivity. So you added more workers to a hospital and you got less output. That wasn't sustainable. I don't know what the correct measure was, but somehow it wasn't very efficient. It's one of the reasons why costs are rising twice as fast as overall inflation. So this is probably a good thing from a long-term perspective, that we're going to kind of really reboot efficiency efforts, but it's going to be painful because these are some of the highest hourly paid jobs that are available in the economy. Go ahead and flip to the next one. Got a couple of charts on here that just show you which industries tend to be exposed more from the business cycles. The areas in gray tend to be less exposed, and that's what's kind of the point that I made just a second ago, that typically healthcare employment doesn't fall that much. Government employment is holding up. I don't know that we're going to see cuts in government, but budgets are really going to come under stress. We're looking at the federal government's looking at doing another stimulus program. You've seen that a lot of road projects are being canceled, which is a real shame, because the best time to do those projects is when nobody's driving. But we may see some cuts, or at least or a slowdown in the growth of government employment, because budgets are going to be pressed for some time to come. On the other side, construction is typically very cyclical. It's an activity that social distancing comes pretty natural to. There was a good study. It was done in China on the impact of where people were getting infected by COVID, and most people that get infected by COVID get infected indoors, mostly at home, because somebody's gone somewhere from outside the home and brought it back into the home, and they've infected other people. Being outside where there's a breeze, and construction work, a lot of it's done outside, is pretty good. You've got pretty good social distancing. I've seen some conflicting data there saying, well, if you're hanging drywall, you're working pretty close. But a lot of that can be accommodated by forming teams and working with consistent people. So you're working with teams consistently. So I think construction is going to hold up relatively well during this period, particularly since there was so much activity that was started in January and February because the weather was so mild. That'll carry it through the soft period where new projects are going to hold back. And then I think this summer we're probably going to see activity pick up a little bit. So at least on new project announcements, I think will pick up a little bit. Go ahead and flip to the next slide, which is industries that can work from home. Kind of an interesting one here. Charlotte and Raleigh are going to account for the bulk of the job losses in North Carolina. Very different from what we saw in the last recession. Well, they did account for a big chunk of the job losses, but the rural areas are not going to see as many job losses because they don't have as many jobs in retailing and leisure and hospitality. On the flip side, though, financial activities are the most common activity that can be done at home, or the most prevalent activity that can be done remotely, as are professional and business services and information, which is the bulk of the tech sector. Manufacturing is pretty high too, because that's sales. Although I don't think they're doing particularly well right now. But I think that it's certainly going to hurt that we're losing all these jobs, all these hourly jobs in leisure and hospitality and retailing and at doctors' offices. But the basic structure and financial services, technology, which are important to both Raleigh and Charlotte, I think is going to hold up relatively well. So I don't think it's going to change it's certainly not going to hurt our relative competitiveness coming out of this. I think Charlotte and Raleigh are going to be even more competitive. Go ahead and flip to the next one. Unemployment rate, we're looking to get up to about 15%. That might be optimistic. We don't think it'll stay up there that long. But we do think 15 to 20% unemployment rate for a month or two is very likely, and then we think it'll come back down. In terms of the recovery, when we go from having 100% of seated dining restaurants closed to having 80% closed, that's going to bring back a lot of jobs. And when it goes to 70, 60, 50. And so we are going to see folks come back to work fairly quickly. We're still going to have a relatively high unemployment rate at the end of this year and the end of next year. So we won't recover. We don't think we recover all the jobs that we lost in North Carolina until 2022, early part of 2022. Go ahead and flip to the next one. The small business optimism has come down. It's going to come down further. It's still actually relatively high. It's slightly higher today than it was the month before the presidential election. So it's coming down a lot more. It might even hit the new lows. And if you flip to the next one, you can see why. 51% of small businesses said they only have enough cash to make it through 2 months. It gets up to 75% if you go to 4 months. This was before the payroll protection program was put in place. That has provided some relief. But for smaller businesses, small businesses, particularly minority-owned businesses, and they say they only have enough cash to last a couple of weeks. So there's some real pain here. Payroll protection program, I think, is a great program. I think for all the flaws that have been cited about it, and to come up with something new like this and implement it that quickly, and a lot, most of the money did go to where it was supposed to. Some of it didn't. And the next round is going to come around, and hopefully that'll work a little even better. Go ahead and flip to the next one. Looking at where the loans went, most loans went to most of the loans that were approved were less than $150,000. So most of the loans that were approved were not the big ones that have gotten the headlines. A lot of them were at that $350 to $1 million level, though. Go ahead and look at the next. Flip to the next one. Shows you the industry. About 85% of construction firms are small businesses. There's lots of contractors and subcontractors in there. Professional, scientific, and tech, that is the tech sector. Manufacturing, about a good chunk of manufacturers are small firms, and a good part of healthcare are small firms. So I mean, this is where we've seen it, and I think that's one of the reasons that it surprised a lot of folks when they heard about the payroll protection program, because the news media does a horrible job of talking about small business. Typically, if there's a news story about small business, they go to an independent restaurant or an independent bookstore. And that's not typical of small business. Small business comes in every industry, and a doctor's office is a small business. A car dealer is a small business. Now, Rick Hendrick is not a small business, but someone who, a smaller car dealer would be a small business. An independent family practice medical office is a small business. Someone who owns 3 McDonald's franchises is a small business. So, it really varies. A lot of manufacturers, about a third of manufacturers are small businesses. Go ahead and flip to the next one. Consumer confidence, falling like a stone. This is going to be something that is going to really bear watching. I mean, we want to see how it falls the next couple months. But it's not just a question of reopening the economy. We have to reopen the economy in a way that convinces people that it's safe to go outside and re-engage in the economy. And I think that the consumer confidence indexes will do a good job of picking that up. Go ahead and flip to the next one. This is some data that Open Table provided. You can see how quickly restaurant dining turned down. And you can see where North Carolina and South Carolina came in on that. We tended to shut down the economy a little bit later than some other states, because the COVID outbreak was not it did not develop here all that quickly. Business is down about 100% right now. Go ahead and flip to the next one. You can see the same thing if you looked at movie theater attendance and other things like that. This is a breakout on consumer spending, similar to what I did on employment. The darker areas tend to be more recession resilient. And we've seen a big drop in healthcare spending here Um, and restaurants are not proving to be any recession resistant at all in this go around. Go ahead and flip to the next one. One of the big concerns that we had about the economy, I mentioned in a lot of my presentations that we didn't have any structural imbalances in the economy, which meant that outside of an exogenous shock, which is what COVID is, that the risk of recession were relatively low. The one exception to that is that corporate debt was relatively high. But while debt was high, interest rates are low and interest coverage is pretty low. The Fed did a very good job of expanding the pool of securities that they purchased, and they even agreed to buy high yield bonds on bonds that had become high yield, meaning they were fallen angels. They were investment grade and fell below investment grade after March 24th, which is when Ford was downgraded. They did a very good job of trying to contain the damage in the corporate market. They did a very good job of restoring order in the treasury market. And so, this is still a concern, but the Fed's did a good job of containing it. Go ahead and flip to the next one. Interest rates are at zero. They're going to stay there for a long time. Rates are going to be low for a long time. Go ahead and flip to the next one. Go ahead and flip past this. Flip past that to inflation. Get a lot of questions about inflation because we've got this huge budget deficit. Now we're gonna double the size, or probably almost triple the size of the national debt because of this crisis. And the Federal Reserve is buying a lot of that paper, and we've seen a big increase in the money supply. And we are going to have an inflationary response. Right now, though, oil prices were negative. Oil prices are low. We've had a big drop in aggregate demand. And so we don't really have to worry about inflation for the time being. But in 2022, 2023, you see how this inflation's been below the 2% line for most of the last decade. I'm not looking for Armageddon on inflation, but I think it's going to be mostly above that line in the next decade. And that's going to be somewhat problematic. We may have a little bit higher interest rate profile than we've been used to. It's going to mean that real incomes are going to decline for certain parts of the economy. But I just don't see how we're going to avoid it. The other thing that's going to happen in the inflation outlook is that inflation has been, the inflation trend changed after China joined the WTO. And I think that global trade is going to be impaired for the next several years. And that's going to add to inflationary problems too. Go ahead and flip to the next one. If you look at this building cycle, this is non-residential structures, which includes all the office buildings, industrial buildings, warehouses, retail stores, and oil investment, which is what most of that growth was in the middle of the decade. We haven't built much stuff in this cycle. And you look at how much we built in this cycle from the prior peak to where we are today relative to other business cycles. And we don't have an oversupply of office space. We don't have an oversupply of retail space. Well, we have not an oversupply of retail space. We have antiquated retail space. We don't have an oversupply of industrial space. We are going to have an oversupply of apartments. Go ahead and flip to the next one. Fairly good growth in residential commercial construction in terms of dollars, in terms of nominal. Go ahead and flip to the next one. In terms of apartments, the apartment vacancy rate, relatively low right now, 6.3% nationally. Not too much above the lows that we saw in the cycle, which were 5 3/4. Rents have been pretty good. This is fourth quarter numbers. There are over 600,000 apartments currently under construction in the United States. We've been delivering around 300,000. So we've got twice as many. We got a lot of apartments in the pipeline. The mix is a little different. They used to almost entirely be luxury lifestyle apartments in downtown or urban locations. Much more, a larger proportion of them are suburban, garden, or mid-rise apartments in the suburbs. So the mix is a little bit different, but we're going to have an oversupply. And job growth is going to be slow for the next few years because we're going to be recovering jobs that are lost. So, net job growth over the next 2 years largely going to be non-existent. So absorption is going to be very weak, and that's going to be problematic. Charlotte has the third largest proportion of units under construction as a share of inventory in the country. Raleigh had their boom a little bit earlier. Most other markets in North Carolina are not really out of kilter. Charlotte and Raleigh were two of the top 10 apartment markets in the country, and so they've gotten a little bit overdone. Go ahead and flip to the next one. In terms of single-family housing, we do see a shift back towards single-family housing, mainly because the millennials are aging up. The oldest millennials turned 39 this year, and the number of millennials turning age 40 will rise every year, from 2021 through 2032. When you look at single-family housing construction in the United States, we have typically built one single-family home for every 40 people, I think. I'm thinking that wrong. Sorry, we typically built 40 single-family homes for every 1 million persons in the United States. And in the last decade, that dropped in half. It dropped to 20 single-family homes per million. We're assuming that we're going to mean revert to 30 single-family homes per million by the end of the decade. And that is just our reversion to the mean guess, saying I think we're going to get halfway there. I think that the COVID crisis might encourage that because you got a lot of the apartments that were built are relatively small to make them affordable. My neighbor's not going to help me out with the leaf blower and everything over there, but they're relatively small. They had a lot of common areas. Of course, those common areas were all shut down as the COVID crisis took off. Go ahead and flip to the next one. In terms of the housing market, we have seen a big rise in the number of mortgages that have gone into forbearance. I was watching Diana Olick on CNBC this morning, and she says, yes, it's okay to miss your payments. And I'm like, you're not missing a payment when your loan goes into forbearance. You're not incurring a delinquency. If you do it correctly, you're not delinquent. But what happens is the mortgage is just pushed to the end. Your principal and interest is pushed to the end. And I believe you're still accruing interest on the whole damn thing too. So there may be some special provision that in regard to COVID where they does not accrue interest, but it's like a payment holiday. A payment holiday doesn't affect your credit, at least not directly. It shouldn't affect your credit score. It would a little bit that your outstanding debt would not be going down, but it would not. Doesn't show up as a late payment. It's probably the best possible outcome that we could do right now, and I think it will help prevent home prices from falling, particularly in hard-hit markets. Go ahead and look to the next one. This is just the demographic profile. As I mentioned, millennials are getting older. Even before the financial crisis, we were seeing fewer breweries open and more breweries close. So we're seeing a little bit of a shakeout there because when you get in your late 30s, your metabolism is not churning as much. Maybe we'll get wine rooms instead. I don't know, but millennials are getting older. Maybe they'll get married and have children and live happily ever after. Go ahead and flip to the next one. The other thing that we saw prior to the recession was the emergence of an affordability migration to the Southeast, to the South, including Texas. Over 60% of the homes built in the last year were built in the South. And those are predominantly Texas, Florida, Georgia, the Carolinas, and Eastern Tennessee. That is predominantly where all the home building is taking place in the South. 60% of all the homes built in the United States. Because of that, we're also seeing an influx of building supply companies coming into the South too. So we've had a lot of investment in lumber yards. Some of that was an offshoot of the restrictions on Canadian imports. Recently in Charlotte, a Chinese cabinet manufacturer has leased the former Philip Morris space or purchased the former Philip Morris space to produce cabinets. Cabinets are a big import from China right now. It's one of the things that it's a little bit troublesome for the home builders that are targeting the mass market because they import a lot of components, and there's some supply shortages and some difficulty in keeping prices down. So we're seeing some of that stuff move to the south. Go ahead and flip to the next one. In the regional commentary, this is just population growth. Last year, North Carolina's population grew 1%, which doesn't sound like much, but that's 4 times faster than the nation. The leader was Idaho, 2.1. Idaho is kind of the hot, Boise's one of the hot markets in the West, as Denver's gotten too expensive, Salt Lake City's gotten too expensive. Other big markets are Phoenix and Las Vegas was very hot. The other thing about Idaho and Utah and Nevada, Northern Nevada, lots of Mormons that tend to have fairly large families, very high birth rates, and so natural increase in Utah, Idaho, and Northern Nevada is about double the nation. Go ahead and flip to the next one. Fastest growing markets from net migration. And I like to look at net migration because this tends to be a better measure of where job seekers are going from one part of the country to the other. And Dallas has been a big winner because Dallas has been getting all these corporate relocations from California and other places. Phoenix has been ascending, Tampa's been ascending. Both took a long time to come back because they were really ground zero for the housing bust. You look at where Charlotte is down there, though. Charlotte is number 7. Just about as many people on net moved to Charlotte from other parts of the country since 2010 as moved to Atlanta. Raleigh and Durham are broken out because this is done by MSA. So Raleigh comes down a little bit lower than that. On a percentage basis, Raleigh's been one of the fastest growing metro areas in the country. Go ahead and flip to the next one. In terms of some more recent data, looking at the data from LinkedIn, and most people are on LinkedIn. Most people that work are on LinkedIn. LinkedIn every month publishes numbers that take a 12-month moving average, and they look at the number of LinkedIn members that they have in a city and say how many of them have moved there in the last year. No surprise, Austin's number 1. I think it's like 144 people of every 10,000 LinkedIn members have moved to Austin the last year. Charlotte is number 2. Raleigh's number 7. 2 years ago, Charlotte cracked this list in the top 10, and it's steadily moved up. It's really been the growth in the tech sector in Charlotte that's been driving this, and particularly in fintech, and that's the big driver there, and that's what's been bringing in a lot of the young folks. And in Raleigh's numbers are really good. The one thing that kind of handicaps Raleigh and Durham is that it's a net number, and people, when they move to Raleigh and Durham, you've got a lot of students that go to Raleigh and Durham and to go to college. They go to Duke and Carolina and NC State and other schools, and they're probably not LinkedIn members, but when they leave, they are LinkedIn members, so it subtracts from their numbers. So college towns do not tend to do well here, although Austin probably has more. Austin has more students than Raleigh does. I mean, it's you've got the University of Texas at 70,000, and Texas State is probably 60,000. So but they still seem to plow through that. Go ahead and flip to the next one. Looking at North Carolina employment growth, it slowed in March on a year-to-year basis. It declined on an absolute basis, and likely to decline further. We've had 540,000 jobless claims in the last 4 weeks. Huge number. Remember, we're expecting to lose around 425,000 jobs, somewhere in that ballpark for the year. So we do expect to gain some of these jobs back. Go ahead and flip to the next one. This is our forecast for job growth. You can see how it bottoms fairly quickly. Kind of looks like a check mark when you look at it this way. But if you fall 10%, and in 2020, we're looking at that's 2021 that would be up there. We're looking to be up about 5 and 5.5% in 2021. We're not going to gain all those jobs back. So go ahead and flip to the next one. Population growth, been very strong. Most comes from domestic migration. International has not been as strong this decade. Natural increase has been a little bit slower too. Go ahead and flip to the next one. The reason natural increase has been slower is that Raleigh and Charlotte have been gaining a lot more people. In the case of Charlotte, Charlotte is gaining a lot of folks in their 20s and early 30s. Raleigh's gaining a lot of people in their early 20s and older residents. Charlotte's getting a lot of older residents too. They're tending to be, a lot of them are on the South Carolina side of Charlotte as opposed to the North Carolina counties. Looking at the unemployment rate in North Carolina, it popped up to 4.4%. It's just the beginning. It's going to surpass the levels that we've seen there. 540,000 job losses equates to about 14% of the workforce. So, I wouldn't be surprised if we had an unemployment rate of 12 to 15% next month. Go ahead and flip. This shows you net migration by metro area, 2010 to 2019. And you can see this is absolute numbers. Eastern North Carolina has been struggling. The hurricane that we had a couple years ago it's been a real slow recovery. Winston doesn't look as strong, but it has actually been gaining considerable momentum since the middle of the decade. Same is true of Greensboro. It's been a little bit less momentum, but it's been gaining momentum. Asheville, Wilmington, both have been doing very well. They get a lot more retirees in addition to job seekers. Go ahead and flip to the next one. Looking at the food groups here, just kind of a comparison with office vacancy rates in the North Carolina MSAs and office vacancy rates in other parts of the South. Our office markets are very well balanced. Charlotte has been one of the hottest markets in the country. We'll get rent growth 7.5% over the last year. Raleigh's got really good rent growth too. It's one of the reasons that we're seeing construction perk up. Greensboro's got a little bit more vacancy, a little bit less rent growth. Going to be a little more selective in office development. Very little vacant space in Asheville and Wilmington, but demand is not growing all that rapidly. Wilmington's probably has seen the stronger growth there, as they've got a little bit of technology, a little bit of finance, a little bit of a lot of different things that are going on in that market. Go ahead and flip to the next one. Looking at the apartment market, apartment vacancy rates, they picked up a little bit. Even though Asheville's got the highest vacancy rate, I'm not overly worried about Asheville. They don't have the tidal wave of deliveries that Charlotte has. Raleigh's still got a lot of deliveries too. Rents are going to come under pressure. Got a lot of people that haven't been able to pay their rents. The law against evictions gives renters a little bit more power. Greensboro and Wilmington, pretty good balance of those markets. Going in the apartment market, it hasn't been as much delivery. In terms of retail vacancies, it's kind of hard to make sense of retail vacancy because you've got a lot of obsolete space. A lot of that obsolete space is bounce houses or some sort of kids activity, climbing things, that I don't know that they're really paying the rent. They're just making use of the space while it waits for its next use. On the flip side, mixed use is in real high demand. Where retail does very well is where shopping is ancillary to what other activity is taking place. That's where it tends to do relatively well. And those rents tend to be a little bit higher. But then on the flip side, there's another area where you get a lot of retailing, and that is that given all the growth that we're seeing in urban style apartments, retail is viewed as an amenity, and also in office development too. And in those cases, typically there's not enough business to make the rent, and so it's like a loss leader to help market apartments or market office space. So there's a lot going on behind the retail vacancy numbers, and I imagine that in this scenario that it's going to allow folks that are looking at retail as an amenity to be a little more selective as to what tenant they're going to take. If they're going to be subsidizing somebody, they want to subsidize exactly what they want. But it's going to be a soft market because we're going to see the number of retail chains is going to contract by a fairly significant number. I mean, you really have to make a convincing case to me that we need full-fledged retail stores. I mean, I know that we're still going to have a Nordstrom. Macy's may make it. I don't know. I kind of feel like of the stores in this market, I think I've always thought that Belk had something a little bit more unique. Dillard's probably has something too, but who knows? I can't see more than two surviving. Go ahead and flip to the next one. Industrial market's been pretty strong. A lot of the growth has been in two areas. It's been around the ports because of surging volumes of international trade. That's going to slow. It's probably going to impact Savannah more than most markets around here. I don't think there's going to be any real problems there. Charleston's always been pressed for space. The other has been fulfillment centers because of the surge in online retailing. The other area that we may see some growth in is in industrial that is tied to some reshoring of manufacturing. We are going to see some reshoring of manufacturing. That may be beneficial to a Greensboro, also to a Charlotte, also to a Hickory, maybe to an Asheville too. I mean, most of that manufacturing is probably going to be in the central Piedmont, not so much to the east. Go ahead and flip to the next. Just a couple of charts here. These are just Charlotte employment growth. You can see how strong it was across the board in just virtually every industry prior to the recession. Flip to the next one. One of the things that's unique about Charlotte, and this is one of the things that concerns me in regard to the recovery from COVID, is that North Carolina is ahead of South Carolina in terms of the recovery process. North Carolina shares a border with South Carolina. The fastest growth in Charlotte has been North Carolina. Charlotte shares a border with South Carolina, so does North Carolina. But fastest growth in Charlotte has been on the South Carolina side. You can see by a considerable margin. This is in terms of employment growth. And I am a little concerned that Charlotte may take longer to recover, and may have more potential for a relapse of COVID cases. The other issue with Charlotte is it's much more urban than any of the other economies in North Carolina. And the more urban areas, the areas that have mass transit, you got a light rail, you've got a lot of people living in close proximity, they tend to have greater problems with COVID. So, while I think the state should be in good shape to open up, I think Charlotte's recovery may be a little bit slower. So go ahead, flip. I think it's the last slide. This is our forecast going out. We will have a forecast update before too long that quantifies that second quarter decline in GDP a little bit more. So let me stop there and open it up for any questions.
Okay, great. Thanks, Mark. And if anybody wants to chat a question, or I can unmute you, feel free to. Or you can unmute yourself and just ask him a question if you like.
I have a question. Chris?
Go right ahead.
Jack, Mark. Mark, you have the unemployment figures. Does that factor in any allowance for the people that are trying to make claims and just can't get through to the state authorities?
Well, it does not, because I don't have a way of knowing who hasn't made a claim. But on the other side, you've had people that have made claims that weren't eligible to make claims because they were independent contractors. So either they drove for Uber, or they were self-employed. And so, my sense is that on Friday, the law changes, because there's a federal, part of the stimulus is going to provide federal benefits for them, which will be filed through the state unemployment. So I kind of think that that's going to be in there, but I do think that that we've probably passed the peak of first-time unemployment claims. What this measures is the initial claim that you make for unemployment benefits. And then there's another measure of continuing claims, which have continued to rise. But typically, if you filed an unemployment claim, it wouldn't necessarily translate into one lost job, because some people that lose a job find another job. In today's environment, I don't know how many, I think far fewer people are finding other jobs, although there are other jobs. I mean, it's, I've seen lots of stories of people that have gone out and they go into work for Amazon, they're going to work for Target. And I saw some numbers in the Charlotte Observer where both Bank of America and Wells Fargo have between 500 and 1,000 job openings they're trying to fill right now.
Okay, great. Anybody else? Go ahead and unmute yourself and feel free to ask the question to Mark, because I'm not getting anything in the chat.
Mark, this is Adam Johnston. Just want to make sure you can hear me.
Here you
go.
Oh,
yeah, I got you.
Okay. Particularly on the housing market, I'm interested in your view. I see a lot of advertising or a lot of stuff out there about, sales declining, inventory declining, et cetera. And I struggle with equating that with job loss. So if I have less houses in the market, but there's hardly anybody looking because no one's going to look at houses, then, do you really have value loss? So when we think about this crisis on a 6-month or 1-year timeline, should we be worried that it's translating into true value loss that's going to cause people to not pay their mortgages and need to leave?
I don't think so. I think that housing is going to be okay because we underbuilt housing. Housing was grossly underbuilt prior to the crisis, and so I don't think we're going to see big price declines. On top of that, whenever we've had a recession and we've had a loss in income nationally, one of the best ways that you can boost your standard of living is moving to a less expensive area. So we are likely to see an increased in-migration into the South as people try to hold down costs. So from a relative competitive standpoint, I think that the South is going to see an increased inflow. The other is that, in terms of the numbers, the existing market's 10 times bigger than the new home market. And that's just, I'm kind of simplifying it there. It's probably 8 times or something, but it's virtually impossible to sell an existing home right now because of social distancing. You can't show it. So some people have done virtual showings, but listings are down 80 or 90% from where they were a year ago. And that's nationally, that's in North Carolina. I talked with realtors yesterday. Sales that were registered in March, those were closings from January and February. We're going to see it fall again when we get next month's numbers. They're going to be down a lot, and then the next month will probably be down even further, and that may be the bottom of it. What I've been telling realtors is to try to gear up for a good summer because we're hopeful that the virus will subside in the summer, just as most viral infections do. But we don't know that. I mean, Singapore is not very encouraging. Data from Singapore is not very encouraging, although most of the infections are occurring among immigrant workers that are transient workers that are coming in from China. So, we have to see what happens there. But I'm feeling like where I am a little worried that gets into the losses that there's a lot of attention on all the stimulus programs that the federal government's putting in place. The federal government cannot make us whole. So there is going to be a loss of income. I think the way that the housing market adjusts with that is that people remain in place longer, and that's what we saw after the Great Recession. And they build equity, which is easier to do when you have low interest rates.
Yeah, it's just as I apologize. As a quick follow-up to that, how would you feel about a place like Las Vegas with that same question?
Well, I feel more optimistic about Las Vegas than most. In that I pay a lot of attention to Las Vegas. It's a big area of operation for us. They have a huge exposure to leisure and travel. They've been diversifying that. The economy there's gotten more diverse too, because the University of Nevada, Las Vegas had a medical school. When I spoke to our local board there, over half the companies on our local board are tech companies. So there's a lot of tech companies, and the tech companies are not related to gaming. So it is wholesale trade and distribution, California's high taxes, the limitations on mortgage interest deductions and property tax deductibility, which are never going to go away now that we've got these monster deficits. That makes Nevada very attractive. Northern Nevada too is doing very well because of the influx of manufacturing out of California. So I feel okay about it. It's been a long road back. They're getting pro football, which is going to be a big plus, because from everything that I can tell, and we're out in California all the time, Raiders fans are going to go to Vegas. The Raiders fans are going to travel to Vegas to watch the Raiders. So it's kind of a unique circumstance that they have there.
Okay, we got a chat. Is the price of oil likely to rise sharply again during the recovery, or will low oil prices be a longer-term trend?
Well, I think oil prices are going to remain low for a long time because I'm working on a piece right now while we were, was what I was working on before we even got on this call. And my sense, and I was on, I guess on Monday on CNBC, and I took a more bearish view on this. I said, yeah, I know this is the May contract and it's rolling over, but it's rolling over because nobody has any place to put the oil. And what makes you think that that's going to be better a month from now, or 2 months from now, or 3 months from now? And it's not going to be better, because the problem with oil is it's both the supply and the demand. The demand's down because of COVID. People aren't driving, people aren't flying. And by the way, just as kind of a public service announcement, you ought to go drive your car, because if it sits for more than a month without driving it, the gas turns to yuck. It'll foul your fuel injectors. It'll cost you $1,000. So public service announcement: go drive your car. And I'm going to do that this afternoon. But people aren't driving, people aren't using it. So that's the demand side. On the supply side, you can't cut production to zero. If you got an offshore oil platform, it's going to cost you more to shut it off than it is to produce. Your cost of production is negative. So you've got to produce. Russia has to produce oil because they need the natural gas that comes along with it. And that's what the big Saudi-Russia thing was about, was who's going to take the hits. And it's just not possible to shut production to zero. And so there's going to be a lot of pain. And it's going to be a lot of pain in Texas. It's a little bit tougher analysis on Texas than it was previously, though, because the industry doesn't employ as many people as it used to. It's much more efficient. But I think that, I haven't crunched all the numbers, but my sense is that about a third of the industry needs to be consolidated. So we're going to see a lot fewer players, and you'll know that prices have bottomed out. In the 1990s, Exxon bought Mobil when the price of oil was $8 a barrel. So you will know that the price of oil is bottomed out when Exxon and Chevron buy big oil companies, buy another big oil company. And they'll probably buy a couple of small ones before that, but they're going to buy. That's when you'll know that prices have bottomed out. Another issue with oil is that it's in structural decline too. So that's a big issue there. Good news on this. There's a lot of good news though. Food prices are tied to gasoline and diesel fuel. Big part of food prices. Also a big part of construction materials prices. So those lower energy prices will help.
Okay, great. Someone said, you mentioned multifamily inventory. Are a number of those in the affordable housing category?
No, there's not much affordable housing being built, unfortunately. The problem with affordable housing is that there's so many dictates that are laid out there that it's almost impossible to build affordable housing. And we really wonder what's going to happen. Mass transit's going to struggle a little bit here. Cities are going to have to come up with ideas as to how to make mass transit safer. in the period leading up to when we get a vaccine. So we're going to have to rethink about how we do affordable housing, how we do transit, and there's no real good solution there. But a larger proportion of the apartments that are being built today are more affordable. We were seeing 85% of the apartments from like 2010 to 2017, I think it was, maybe in 16. 85% were luxury lifestyle, very high rents, and so that's changed a little bit over the last couple of years, where we're seeing that a larger proportion are workforce. I don't say workforce, but they're geared more toward the middle.
Great. All right, if anybody else, I don't have any other chats here. Mark, thank you so much. Some of you received the upload that I put into the chat. If you didn't, we'll send it out to everybody. And remember, Peter Christensen will be on May 15th. He worked with LIA often, so that might be helpful for some of y'all. Thanks, Mark, very much, and look forward to having you on again.
Great. All right. Good talking to you.
You too.